Something weird has been happening in the world of finance. Trading is starting to feel less like, well, investing, and more like a game on your phone. You've got these slick apps, numbers flashing everywhere, the promise of a quick win. But what really happens when the stock market starts looking like a digital casino? Let's follow the money and see what's really going on.
To get a sense of just how big this is, let's start with a number. $4.3 trillion. That's the daily trading volume for equity derivatives. Not for the whole world, for India alone. That is an absolutely staggering figure, and it tells us there's been an explosion in trading activity.
And this is where it gets really wild. This chart puts that number into perspective. It shows how much derivatives trading is happening compared to, actually buying and selling stocks. And you can see, derivatives are big everywhere. But in India, the market is over 400 times larger than its cash market. That's just in a completely different league from any other major economy. So what on earth is fueling this boom?
Well, the answer boils down to one powerful trend, the gamification of trading. A few key changes have completely transformed how people participate in the markets, making it feel faster, cheaper, and honestly, a lot more like a high-stakes game. It really comes down to three things. First, the apps themselves are just so easy to use, they're practically intuitive. Second, there's this concept called sachetization that has made trading products way, way cheaper. And third, those cheaper products have unlocked some truly insane levels of leverage.
So what in the world is sachetization? Just think about those little single-use shampoo packets you see at the store. They took something that used to be a luxury product and made it accessible to pretty much everyone. Well, that exact same idea has been applied to trading. Instead of these expensive month-long contracts, the market has completely shifted to much cheaper, shorter-term options.
And these little sachets come in the form of weekly options, or even crazier, zero-data expiry options. We're talking about bets on where the market is going to be by the end of a single day. And people love them. They make up over 95% of all index option trades. But their super low cost enables something else, something wild. And this right here shows the result, a massive explosion in leverage. A normal monthly option might get you, say, 56 times leverage on your money. A weekly option, that jumps to 126 times. But a zero-day option, a retail trader can get over 420 times leverage. That means a tiny, tiny bet can control a huge position, which, yeah, amplifies your potential gains, but it also amplifies your potential losses into oblivion.
So, with this unbelievable volume and all these new people jumping in, you have to ask, right? If this whole thing is a game, who's running the casino? And more importantly, who's really getting rich from it?
Well, when you start to follow the money, a few key players pop up again and again. They are just perfectly set up to profit from this kind of high-speed, high-volume environment.
It's really a winner's circle of three main groups. First, you've got the brokers. They make a little bit of money on every single trade. Then you have the market makers who profit from that tiny little difference between the buying and selling price. And then there's this new and incredibly powerful group, the online trading gurus.
And a key piece of the puzzle here is something called payment for order flow, or POF. The best way to think about it is like this. Imagine a travel agent gets a kickback for booking you on a specific airline, even if it's not the cheapest flight. That's POF. Market makers pay brokers to send their customers trades to them, and that creates a pretty obvious conflict of interest. Is your broker sending your trade to the place that gets you the best price, or to the place that pays them the most?
And then we get to the gurus. This quote from an industry insider, Renee Balk, just pulls the curtain back completely. He makes it crystal clear that for a lot of these online trading influencers, the main business isn't actually trading at all.
In fact, Balky breaks down his own non-trading income. Yeah, sure, some of it comes from YouTube ads, but the real money? It's in broker affiliations, where he gets a cut of the fees from every single follower who signs up and starts trading. And of course, they're selling products like trading courses. The incentive here is perfectly clear. Get your audience to trade as often as possible because that's what drives the entire business model.
So we've seen who wins in this ecosystem. The house has a lot of ways to make money. But that brings us to the person right at the center of it all, the individual trader. What are the actual odds for the player in this game, and what's the real cost of playing?
Okay, this comparison is just fascinating. In something like fantasy sports, for every $100 that goes into the prize pool, about $85 gets paid back out to the players. But in retail options trading, that whole dynamic is flipped completely upside down. For every $100 in the pot, only $15 comes back to the group of retail traders.
And if that wasn't stark enough for you,
Get this. A study by India's main market regulator found that 9 out of 10 individual traders who get into the derivatives market end up losing money. The odds are just overwhelmingly stacked against them.
But it's not just about the money. There is a huge human cost. A professional trader named James Rosenthal talks about this world, filled with constant, crushing pressure, where that line between a calculated risk and just spinning a roulette wheel gets dangerously blurry.
It really is a high-stakes bet, and it takes a toll that's way bigger than just what you see in your bank account. The psychological burden can be absolutely immense.
Rosenthal describes it as a low-level hissing of anxiety that just never goes away. When you lose, it doesn't just drain your account. It completely shatters your confidence. Your sleep suffers, your relationships suffer, and your entire sense of who you are can get wrapped up in the daily ups and downs of your P&L statement.
So, if this system creates such terrible odds and so much stress for the individual player, you have to wonder, are there other ways to build a market? Let's just zoom out for a second and look at an alternative.
And for a really interesting case study, we can look at the United Kingdom. They took a very, very different path on one of those key issues we talked about earlier, payment for order flow.
So here's what happened. Back in 2012, regulators in the UK effectively banned PFOF. They just removed that core conflict of interest for brokers. And the result? Well, with brokers now forced to actually compete on who could get the best prices for their clients instead of who offered the best kickbacks, the number of trades getting the best possible price shot up from about 65% to over 90%. The CFA Institute basically concluded the ban made the market more efficient, more like a utility, where the price you see is the price you actually get.
And that really brings us to the final question. As technology keeps making trading faster, cheaper, and more like a game, the real challenge is figuring out the right balance. How do we keep markets open for everyone, while also making sure that the players aren't just being set up to play a game that they are almost guaranteed to lose?